Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in corporate filings. And today we're diving deep into Logitech's 2025 Annual General Meeting invitation and proxy statement. And let me tell you, it's got more twists than a pretzel in a wind tunnel. They're calling this a preliminary proxy statement, which means they're giving us the first look before the final details are ironed out. It's like getting a sneak peek at a movie trailer, and we're here to tell you if it looks like a blockbuster or a flop. Logitech, the folks behind those slick computer peripherals and gaming gear, are gathering their shareholders to talk about the company's future. It's a big meeting happening in September 2025, and they're laying out all the important stuff we need to know before we cast our votes. First up, they're asking for approval of their annual report and financial statements for the year ending March 2025. This is standard procedure, but it's where we get to see how they actually perform. Think of it as the company's report card. Then we get to the juicy stuff, executive compensation. They're asking for an advisory vote on how much they paid their top bosses. This is the say on pay part, and let me tell you, it's always a hot topic. We'll be looking closely at the numbers here to see if the pay matches the performance. They also have a separate vote on their Swiss statutory compensation report. This basically means they have to follow some specific Swiss rules about how they report and get approval for executive pay. It's like a special compliance check. And then there's the non-financial matters report. This is becoming more and more important these days. It covers things like sustainability, environmental impact, and social stuff. It's a big deal because it shows how companies are trying to be good corporate citizens. Now, for the part that most people really care about, the dividend, they're proposing how to use their profits and whether to pay a dividend to shareholders. This is crucial because it directly impacts what shareholders get back on their investment. They also want to renew something called the capital band. This sounds a bit jargony, but it basically gives the board the power to issue or buy back shares for a set period. It's like giving the board a credit line for company stock. Then there's a proposal to release the board and execs from any liability for their work during the past year. This is pretty common in these types of filings, sort of legal clean slate, but it's important because it means shareholders are saying, okay, we trust you did a good job. And of course, elections for the board of directors, they're proposing a slate of candidates, and we'll be checking out their backgrounds to see if they have the right mix of skills and experience to lead the company. Let's get down to the financials. The report tells us that for fiscal year 2025, the company's total sales went up by 6%. That sounds pretty good, right? But when you dig a little deeper, they say this increase was mainly because of better demand for their gaming gear, keyboards, and tablet accessories. It's important to see where the growth is coming from, and it seems like some of their popular product lines are doing really well. Now, let's talk about gross margin. It increased by 170 basis points to 43.1%. Now, a basis point is a small chunk, 1/100%. But 170 basis point increase is significant. This means for every $100 of sales, they are making about $1.70 more profit after covering the direct costs of making their products. They attribute this to lower product costs, which is great, but they also mention it was partly offset by higher promotional spending. So they made more money per product, but then spent more on ads to make sure they sold them. It's a balancing act. And get this, they generated about $840 million in cash from operations. That's more than their entire operating income. This is a really strong sign of financial health. It suggests they're really good at turning their sales into actual cash, which is vital for running a business and paying dividends. Remember, cash is king. Looking at the board of directors, they're proposing 11 nominees. They've provided a whole lot of detail about each nominee's background, experience, and skills in this report. It's quite extensive, and they've even included a handy chart of their board skills and experience profile. When picking directors, companies really try to cover all the bases. They want people with experience in senior leadership, especially important for guiding strategy. They also value governance experience for making sure the company is run properly, and financial expertise is a must for understanding the numbers. And let's talk about the compensation committee. It's crucial that this committee, which decides on executive pay, is made up of independent directors. Logitech states that their compensation committee is composed solely of independent directors. This is a best practice that helps prevent conflicts of interest. Now, something interesting under the what we do not do section, they explicitly state no severance or change in control arrangements. This is often a nod to Swiss corporate law, which can be stricter about these kinds of payouts to executives compared to companies in other regions. It means that if there's a takeover or an executive leaves, they likely won't get a massive payout. Beyond their earned can be seen as vested equity, which is a move that can be seen as very shareholder friendly. Okay, let's get into the nitty-gritty of executive compensation with the compensation discussion and analysis. This is where they explain how they come up with the pay for their top bosses. They've got a pretty clear philosophy: attract and keep talented people, support a performance-oriented culture, and make sure most of the compensation is tied to the company's performance. They want to align executive pay with shareholder interests, which usually means linking a good chunk of it to how the company's stock does. Let's peek at the numbers in the summary compensation table for fiscal year 2025. For the CEO, Johanna Faber, her total reported compensation was a hefty $10.5 million. Notice that a big chunk of that, over $50 million, came from stock awards. This reinforces their strategy of using equity to align executive pay with long-term shareholder value. The Chief Financial Officer, Matteo Anversa, had a total compensation of about $6.1 million. Again, stock awards make up a significant portion, around $3.9 million. This is standard practice to incentivize long-term commitment and performance. The stock awards column in these tables is where we see the grant date fair value of equity given to executives. It's not necessarily what they received in cash, but the value of the stock grants at the time they were given. For PSUs or performance stock units, the actual payout depends on the company hitting specific performance targets. It shows a commitment to pay for performance, but it's important to remember that the final realized value can be very different depending on how well the company actually performs. On the broader company scale, let's look at employee numbers. Logitech had a total of 7,148 employees as of fiscal year 2025. What's interesting is the gender breakdown. 37% of all employees are female. They also provide details about gender in management roles, noting that 36% of all managers are female. And in STEM-related positions, it's 23% female. So while they're making progress, there's still a clear gap, especially in STEM roles. Logitech is really emphasizing their commitment to sustainability. They call it Design for Sustainability, or DFS. They're trying to make products that last longer, use fewer resources, and are easier to recycle. They've got principles guiding them, and they're trying to incorporate sustainability right from the design phase of a product. This is becoming a huge selling point for consumers who care about the environment. For instance, they're using next life plastics in a whopping 78% of their products. That means they're using recycled plastic, which is a pretty significant move away from virgin materials and a clear win for the circular economy. They're also focusing on things like low carbon aluminum and FSC certified paper packaging. Looking at their share ownership guidelines for directors and executives, they seem pretty strict. Non-employee directors need to own stock worth 5 times their annual cash retainer, and they have a certain number of years to meet that. If they fall below that level, they might have to receive half of their board retainer in shares. This is a good way to make sure the people running the company have some skin in the game, meaning their own money is invested in the company's success. In their environmental section, specifically on biodiversity, they're analysing risks related to their operations and their supply chain. They've mapped out their facilities and are looking at how their business interacts with natural resources, especially in areas where water might be scarce. They're being mindful of their impact. When it comes to business conduct, Logitech is making a strong statement. They reported 0 confirmed incidents where contracts with business partners were terminated or not renewed due to corruption, plus 0 legal cases related to organizational corruption. This is a really positive sign of their commitment to doing business ethically. Now for my take. Logitech seems to be playing a smart game. They're definitely leaning into sustainability, which is not just good for the planet, but good for business as consumers increasingly demand eco-friendly products. Their focus on recycled materials like Next Life plastics is a concrete example of this. Executive compensation is high as expected for a company of this size and scope, with a heavy emphasis on stock awards, which in theory aligns their interests with shareholders. However, the actual value realized from these awards can fluctuate significantly with stock performance. The pay ratio showing the CEO's pay compared to the median employee is 23:1. While this gap exists, the significant portion of the CEO's pay tied to company performance and stock value is a key factor to watch. On the safety front, the numbers look good for their production facility, with a very low number of recordable injuries and a high percentage of workers covered by their health and safety management system. This shows a tangible commitment to employee well-being within their own operations. Their privacy numbers are also strong, with 0 substantiated complaints or reported data breaches in fiscal year 2025. This is critical in today's world where data security is paramount for consumer trust. Overall, Logitech appears to be navigating the complex landscape of corporate responsibility and financial performance with a clear strategy. They're focused on innovation, increasingly efficient operations, and addressing modern consumer demands for sustainability and ethical business practices. The leadership team's compensation, while substantial, is largely performance-driven, with a good portion tied to equity. The company faces risks, of course, most notably regarding supply chain stability and raw material costs, but they seem proactive in diversifying and managing these. Alright, that's our breakdown of Logitech's proxy filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord server in the description below for more insights and discussions. Thanks for watching. See you next time.